An introduction to credit management structure. So in this session, we will see the significance of credit. We will see what leads to inflation and how Reserve Bank of India counters it. As we know, national economy is driven by credit and credit management. Without availability of credit, an entrepreneur normally would not take up big or large projects. So credit management leverages an entrepreneur to take up such projects. It also helps individuals to make purchases of assets on credit and later repay them out of future earnings. Credit increases market demand, and this demand drives the producers to increase production. Availability of cheap and adequate credit propels the economy to greater growth trajectory. But there's a catch in all of this. There is in fact a delay between increases of demand and the creation of supply that would satiate those demand for products. So that's the reason why excessive availability of credit for non-productive purposes increases the inflationary effect on the economy. So for that reason, the central bank, here Reserve Bank of India, uses monetary tools such as cash reserve ratio or statutory liquidity ratio, bank rate to control credit so that a good balance exists between inflation and economic growth. Next, we'll see principles of credit. So these are purpose, safety of funds, profitability, liquidity, security, risk spread. So these are unwritten principles. And over the years, banks have evolved what is called as a set of basic principles in the case of lending operations. So we'll briefly see what each of them are. Purpose. What exactly it is? It's a basic principle. It actually says what a loan policy serves. Safety of funds. So it actually sees how certain is repayment of loans. Will there be a condition of willful defaulters? Profitability. How much does the lender gain? That is the profitability of credit. Security. How difficult is the recovery of loan or the recovery process. Liquidity is there and risk spread is also there. Now, governance of borrowers. So what exactly it is for credit management purposes, a set of borrowers are usually identified. Now these may be individuals, sole proprietorship, partnership firms, joint firms, HUF or Hindu undivided family, companies, statutory corporations, trust, etc. Now, the laws applicable in each case, we have to just mention, in the case of this, borrowers, and thereby the governance of borrowers will be in effect. So for individual, it may be governed by Indian Contract Act. Sole proprietorship. It will be a firm with borrowing capabilities. Partnership firm. It is governed by Indian Partnership Act. Joint firm is there. Hindu undivided family is by customary laws pertaining to Hindus. Companies are governed by Companies Act. Statutory corporations by acts that have created them. Trust is by Indian Trust Act, Public Trust Act, Religious and Charitable Endowment Act, Waqf Act and Cooperative Societies. Next is credit types. So here we actually see there are different types of credits which are fund versus non-fund based credit types. In non-fund based credit types, the examples may be forward contract or letter of credit. There exists other classification of credits, short-term and long-term. There also exists classifications of credit based on credit purposes. So credit types basically are bank credits which can be fund versus non-fund based credit. Now in fund based credit, there is an actual transfer of money from the bank to the borrower. In non-fund based credit, that is not the case. There is no transfer of money, but a commitment exists from the bank on behalf of the client and may end up in future transfer of money. So examples may be bank guarantee issued in favor of government departments on behalf of a contractor who is a bank's customer. Now, if beneficiary invokes the guarantee, bank pays or remits the amount. There are also other forms of non-fund based credit, which are forward contracts and letter of credit. Also, there exist other classifications of credit, which may be short term, which is credit given for short term, and long term, which is a credit given in the long term. Term loan is an example. Also, the classification of credit may be based on purpose. What does it serve? Which may be working capital finance, project finance, export finance, etc. Next is credit management mechanisms. So the credit management mechanisms mainly revolves around banks' loan policy. It may revolve around appraisals. It may also have to do with delivery, control and monitoring, credit risk management, etc. We'll see in a little detail, not very detailed discussion, but in little detail what each of them actually means. So first is the credit management mechanisms, which are banks' loan policies, one such credit management mechanism. So here there is exposure limits for single borrowers, individual sectors like real estate, capital markets, etc. There also exist discretionary powers at various levels. So bank's loan policy, generally it's in every bank in India formulates its own loan policy, and it is mandated that within the framework of this policy, should any sanction of any credit proposal need to be written. So the formulation of loan policy is influenced by such factors as banks' own SWOT analysis, factors such as market conditions and policy of competitors, as well as on RBI guidelines. Now, guidelines on the following aspects run the loan policy, which are exposure limits for single borrowers, exposure limits for individual sectors such as real estate, capital market, etc. Now, banks constantly watch these sectors, and if banks' understanding about a certain sector deteriorates in value, the bank reduces exposure limits and demand fresh sanctions of credit proposals. In some extreme cases, banks may exit out of existing accounts by formulating exit strategies. Next is discretionary powers at various levels, which is again bank's loan policy. So discretionary powers at various levels sanction credit proposals. The policy lays down powers given to various authorities for placing ad hoc limits or for allowing overdraft or overdrawings, actually, not overdraft, overdrawing. Now that is about bank's loan policy. So we have exposure limits as well as discretionary powers at various levels. Appraisal, what exactly it is? Lenders may introspect certain aspects before lending his money out to borrowers, and they may ask some typical questions to themselves. So what are those questions? They may ask, borrower, is he trustworthy? What is the borrower going to do with the money which I lend out? Should I give him the amount he has asked for? What should be the terms of repayment? So these are some of the questions which the lender asks or introspect. So he wants answers to all these questions. Now the process for filling these answers to these questions is credit appraisal. So depending upon various factors such as amount involved, duration of the loan, purpose of the loan, category of borrowers, risk involved, securities available, RBI guidelines, etc., the complexity of appraisal also changes or varies. Hence, appraisal may differ when considering a loan proposal for crop loan versus loan proposal for vehicle loan. So that's about appraisal. Okay. Next one is delivery, which is a credit management mechanism. So it's actually part of the credit management process. Now, what is it in delivery? So this has direct relationship to creation of charges over security as well as on documentation of the loan. So it covers methods of delivery such as loan or cash credit in case of working capital limits, and involves certain procedures for the disbursal of term loans. So that is delivery. Next, credit mechanism, credit management mechanism is control and monitoring. So what does that make sure in terms of credit management? What does it make sure? Control and monitoring. So control and monitoring makes sure safety of banks' funds. So safety of banks' funds is made sure while one does controlling and monitoring. It is also in the interest of the borrower that the lender does control and monitoring. Next is credit risk management. Credit default is possible despite the best of loan policies involving steps, appraisal, delivery, control and monitoring, etc. due to genuine business problems or due to intentional or willful defaulters. So basically credit default is possible. And the reasons are genuine business problems or it may be willful defaulters. In the first case, banks provide, which is the first case, which is genuine business problems, banks provide additional assistance or concessions to help enterprise make its operations workable again. This is generally what is known as rehabilitation of sick SSI units and corporate debt restructuring. So that is the first case, genuine business problems. Banks genuinely try to help the defaulters, not defaulters, the banks genuinely assist them or provide concessions to the enterprises, making it work again, making their operations work again. So this is basically what is rehabilitation of sick SSI units and corporate debt restructuring. In the case of willful defaulters, what the bank does? So in those cases where rehabilitation has not worked or yielded the expected results or considered not feasible or for willful defaulters, banks start the recovery process. So that is what happens. Next is RBI's role in banks' credit management. RBI or Reserve Bank of India has a direct influence on credit management, especially in the credit management of any bank in India. So ensuring compliance and keeping up with RBI's guidelines is an important work of the bank's credit department. So some of the guidelines from RBI that directly influence the bank are priority sector and end use of funds. We'll just briefly go through what exactly are the RBI guidelines. Detailed information if you want, you have to basically go to RBI's website. So here we actually briefly say what exactly it is in priority sector as well as in end use of funds. In priority sector, RBI as regulators of the bank include industrial sectors in the priority sectors and also the minimum percentage of total credit of a bank that should go into the sector. So that is the guideline for priority sector. For end use of funds, monitoring banks' fund flow as well as ensuring proper end use of banks' funds are the primary responsibility of the bank. Bank should also make sure that withdrawals from cash credit or overdraft accounts are strictly for the purpose where credit limit exists and are sanctioned by the banks. No diversion is entertained of working capital finance for acquisition of fixed assets, investment in subsidiaries or associated companies, and for the use of acquisition of debentures, units of mutual funds, shares, as well as other investments in the capital market. So this wraps up a session on Introduction to Credit Management Structure. Thanks.